Good afternoon, everyone. I apologize that I am a couple minutes late. My name is Jung Seh. I am a financial advisor at Bogart Wealth. Welcome to our webinar this morning. Are you ready to retire? I have the chat box open, so if you would like to ask any questions, I will try to monitor that during the presentation and answer your questions along the way. So thank you for attending today. The areas of discussion I'm going to cover today include an introduction to Bogart Wealth, an overview of things to consider when you are confronted with the questions of, am I ready to retire? Third, an understanding of creating a retirement planning process. How do you take the emotion out of your decisions? For those of you who might be new to our firm our mission is to help clients achieve financial peace of mind by preserving and maximizing intergenerational wealth. A little background on us, we have 2.9 billion assets under management, working with 1,377 households and growing. We are a registered investment advisory firm, which means that we are an independent fiduciary advisor working in your best interest. We are registered. We custody our assets at Charles Schwab for your protection. We are a fee-only wealth management firm, assets and households per week, weekly update as of June 30th, 2025. So we have a full operations and financial planning team in our Virginia and Texas offices. Bogart Wealth has financial advisors located in both McLean and Houston, and we work with clients in numerous states across the country. We have a full operations and financial planning team in our Virginia and Texas offices. These are some of our lovely folks. And what's that? Okay. We are headquartered in McLean, Virginia. In addition, we have 2 offices in Houston, one in Gessner and one in the Woodlands. We produce a number of educational webinars throughout the year. We invite you to join featured webinars as well. On our website, bogartwealth.com, we do have some recorded versions of previous webinars, and I highly encourage you to check it out. We have some amazing resources. In addition to webinars, we have podcasts available, and we also have a number of one-pagers that will keep you updated on the latest changes in taxes and just advice on how to, like, for example, sign up for Medicare and lots of very helpful additional resources. So I really encourage you to check out our website. For those of you who work with us, you know planning is at the heart of what we do. Most people think that planning for retirement is just about the investment management piece of it, but everyone's situation is different. And it is important for us to focus on your goals and manage the issues that are important to you. If you are new to Bogart and have not gone through our planning process, I encourage you to reach out to your advisor or myself, and we can talk specifically about what you and your family are working towards. So let's get started. All right, so this is the agenda that we are going to be covering today. An introduction, why it is important to plan for retirement, understanding the risk in retirement, the retirement income planning process, retirement analysis, investment strategy, withdrawal strategy, review and monitor progress, dealing with emotions. So typically your choices are to retire or not to retire, but there are a lot of variables to consider. Consult a certified financial planner and work with a professional to create a comprehensive, objective financial plan. A proper plan can be built with realistic assumptions along with what-if scenarios. A good financial plan takes the facts as we know them today and builds out your financial future using the most realistic assumptions that we also know today. The process will help to make the right decisions. Cash flow is critical. Regardless of the stage of your life, be realistic. You will probably not spend less in retirement than you spend now. Your investment strategy is important, so make sure it is aligned with your risk tolerance so you do not add additional stress to your life. With withdrawal strategy, it is important. Again, make sure it is sustainable. Also have a contingencies plan for the unexpected. Review and monitor your plan regularly when life changes. So first, why should you do a comprehensive objective plan? First, plan for the unknown. There are a lot of risks that you will experience during your retired years. Second, make the most informed decision you can. Start in the right direction that is the best for you and your family. Cash flow is critical. Take a hard look at expenses and income sources. How do you create the cash flow you need is also equally important. A plan is not a one-time event. Life happens, and therefore your plan needs to be monitored and updated as your life circumstance changes. So there are a number of items to consider when you are creating a plan. I have several that I've highlighted for you to think about. This is by no means a comprehensive list. As I stated earlier, this is your plan and should emphasize your priorities. So family, how do your decisions impact those that depend on you? Do you need to consider a spouse, children, or parents? Health. Think about your physical as well as your mental health. Both play a huge part in successful retirement. How does your health affect your spouse or those that depend on you, and how does their health affect you? Again, think of physical as well as emotional. Home. You retire. What are the next steps? Where do you want to live? Where do you want to move to? Do you have a vacation home? Do you want to live in a retirement community? Lots of things to consider. You don't need to answer all of those questions today, but plan for the what ifs. Lifestyle. What do you like to do? How much do those activities cost? What is the equipment required? Is travel costs involved? Think about it. You go from having 2 days off a week to 7 days off a week. What will you do with your time now? Work. Do you want to work after this job ends? Do you need to work? Realistically, consider the question carefully. It intertwines with cash flow as well as emotional health. Legacy. Do you have a goal for leaving a legacy to an individual or to a charity? If so, let's plan for that event. Finally, mind and spirit. What makes you happy? You would think this is a super easy question to answer, but it may not be visible to you completely, especially if you're being presented with the fact that your job is ending. Take the time to think about true happiness, build that vision in your plan. This may change over time as well. Another reason to update your plan on a regular basis. So these are some of the greatest retirement concerns. The lighter blue reflects age, 50 plus workers, and the darker blue represents the retirees. So some of the greatest fears, they range from outliving my savings in retirement, Social Security, that is also a hot topic. Will Social Security be reduced or cease to exist in the future? Declining health that requires long-term health, and long-term care, possible long-term care costs, losing my independence, cognitive decline, not being able to meet basic financial needs for my family, lack of success to adequate and affordable healthcare, feeling isolated, finding meaningful ways to spend time and stay involved, lack of affordable housing. I don't have any retirement fears. That's very low. And being laid off, not being able to retire on my own terms. So these represent again some of the greatest fears, and they are the unknown. And you're going to hear me talk about this a lot throughout the plan. So this is even more so why it's important to plan for the unknown. Okay, so here is a representation of some risk in retirement. So longevity is a risk in retirement. Folks are living a lot longer these days with the advancement of healthcare. For an average couple, age 65, there is a 42% chance that one of them will live to age 90, a 16% chance one will live to 95, and a 3% chance that one of them will live to 100. Inflation, that has been a very hot button over the past several years. A 3% inflation rate will reduce the purchasing power of $50,000 to $23,880 in 25 years. So you really want to consider the income sources that you have, and also try to account for the inflation to that as well, because as you all know, the cost of bread and butter today is not going to be the same years from now. But market performance, sequence of return risk. This is a low negative return, especially early in retirement, can be detrimental to your portfolio. This is something that I think is really important to consider. If you are drawing a certain percentage and then in the year that you retire, we are experiencing market volatility and a downturn, that can have a very negative stress on your portfolio. Volatility, having to sell when the markets are down, places significant strain on your savings. I just mentioned that. Healthcare costs are rising faster than the average inflation rate. So, cost of healthcare costs rises typically at a 5% rate. That is the assumption that we use in our analysis. A recent study estimates a couple age 65 will spend $315,000 in retirement to cover healthcare, not including nursing or home expenses. The final risk I want to emphasize is that your spending is your biggest risk. Be careful of overspending. Create a realistic budget, put it into your plan, update regularly, and plan for what you want to do in retirement, and monitor it consistently. So these are some of the average annual expenditures by age. And as you go through retirement, the cost for the things that you're paying today are going to change. And this is I think a really good visual of that. So I'm not going to go through all of these, but for example, apparels and services, they between 55 and 64. You'll be spending about $1,900 on average, and then it reduces from 65 to 74, and then it reduces by over 30%, almost 40, when you're 75 plus. And these are some of the other expenses that can change over time as well. Okay. So retirement income planning process is a process. It is not just a one-time event. It is an ever-evolving document, and especially during retirement, it's so important to regularly update it. Building out your financial plan is step one. Analyze where you are today, and identify the sources and when the variable income may start, and be realistic. So you want to start off by prioritizing your lifestyle goals, set realistic expectations on financially achieving them. Budget, so important. How much income will you need each year? And your income may change over time. This is a very popular saying, but in retirement, you're going to have your go-go years, you're going to have your slow-go years, and you're going to have your no-go years. You want to set realistic estimates of your expenses. You have your needs, which are your fixed, your essential expenses, like your mortgage and your other liabilities, healthcare costs. Your discretionary are your wants. And then you want to also account for unexpected expenses and or wealth transfer goals. So the step one in retirement analysis, you want to make an inflation assumptions. Healthcare costs rise at a much faster rate than other costs. So you also want to build in extra costs for later years or consider long-term care insurance. Identify your income sources. There's Social Security, employment pensions, personal savings and investments, rental or business income, part-time employment, and determine if your plan works. Use a retirement plan to determine if the assumptions work. To make this generalizable to a wider audience, what I did was I provided sources of retirement income. So Social Security, it replaces anywhere from 90%, but for US medium income, it replaces about 40%. So you have quite a bit, most Americans have quite a bit of a gap, especially these days among private sectors. Only 15% are covered by pensions in 2023. Typically fixed annuity, depending on age, service, Social Security, and then typical career employee replaces about 50% of salary at age 60. And savings and investment, most folks have a 401k, IRAs, TSPs, others. So these must fill the gap of the income shortfall. Step two is creating an investment strategy. So first, understanding your risk tolerance, understand how your investments can change value as you're making decisions on how you should invest your assets. There are a number of ways to create your investment portfolio. We welcome the opportunity to discuss your situation and help build out your portfolio. Okay. So most people have, sorry, I'm just getting to jumping ahead here. But here is a typical overview of annuities. So there are three basic types of annuities. There is a fixed, there is an indexed, and there are variables. And annuities, they provide a guaranteed stream of income, and it may or may not be suitable for you. It again depends on what your income sources are, what your risk tolerance are. So incorporating an annuity to your overall comprehensive plan with all the other variables considered is important. And another investment strategy is a bond ladder. And this is a very simplified example. So you have a three-rung, 3-year bond ladder over a 6-year period of time. So what you do is you start off with one ladder that is invested in something very short term, and then you have another one that is going to invest in 3 years and 6 years. And then as they come due, what you do is you take the proceeds and go back and invest it into the first ladder. So we have growth-oriented versus income-oriented investing. The S&P 500 index value and dividends since 2000. Dividend income flows have been more stable than index value in the past. Dividends do not increase every year, but over time have tended to outpace inflation in the past. So basically, if you are looking for an income-oriented investment, then you investing in companies that pay out regular dividends can help produce steadier income during retirement. Okay. This is called a U.S. equity market performance. It's called a quilt. And this represents all the returns since 2013 to year to date. And this represents all the different sectors of the equity. So this is where I'd like to highlight that diversification is so important. Because you really never know what's going to fare better than others in any given year. Going back to 2013, consumer discretionaries returned 43.1%. And then you have, year to date, we have consumer discretionary, which is all the way down at 3.4. So that's why these colors are kind of all over the place. You never really know what's going to fare better than others. And again, going back to the importance of diversification. All right. So step 3 of the planning process is establishing a withdrawal strategy. The income-only strategy is very popular and easy to understand. You cannot run out of money if you never have to sell any of your investments, if dividends and interest from the portfolio, along with Social Security, are enough to cover your expenses. So income only, withdrawing only interest and dividends from your investments. Systematic withdrawals, that is taking pro rata withdrawals from a well-balanced portfolio. A bucket approach, creating specific portfolios dedicated to immediate, intermediate, and long-term needs. Again, what would be most appropriate for you depends on your specific needs. Okay, so an income-only strategy, this is just an example, but let's say you have a current savings of 1.5 million and your income need is $60,000 a year. So we have your Social Security at $2,000 a month, which equals $24,000 a year. And then we have a bond ladder that produces $15,000 a year, yielding 2%, having invested $750,000. And then the other half of that 1.5 is invested in dividend stocks that are yielding 3% per year. So that's 22,500. So that equals 60,000. A systematic withdrawal strategy, again, same amount, 1.5, $60,000 a year need. Social Security is the same. So We have, in this situation, a balanced portfolio with the entire 1.5 million invested, and withdrawing $36,000 a year from that portfolio. That equates to a 2.4 withdrawal rate. Okay. This is a bucket approach strategy. So in this strategy, we use a bucket approach where we divide out your assets and put some $300,000 for your needs in the more immediate term, 1 to 5 years. So you have a income need of 60,000, and this is where we would have the immediate need, again, the shorter term, 1 to 5 years, invested in something more safer, like cash and high grade bonds. And then the intermediate years, years 6 to 12, we would invest about 400,000, and we would invest any excess income generated from this bucket and redistribute it to bucket one. And in something like this, in the intermediate, we would take a little bit more risk that, produces a little bit more income and generate some growth as well. And that would be a mix of bonds and some stocks. And for the longer term, years 13 years and out, we would invest about 800,000, and any excess that income that is generated from this bucket would be redistributed into the following, the bucket one and bucket two. And this, in the final bucket, we would be taking more risk than bucket two, and would be invested more in stocks and slightly higher risk for better long-term return. So how long will my portfolio last? So at a 4% withdrawal rate is safe for a 60-year-old. They can live to 100 without running out of money. At a 5% withdrawal rate is, and I want to use the term quote because this isn't this is a very highly generalized number of figures here. So this doesn't go across the board, but in generally a 5% withdrawal rate is safe for a 70-year-old, a 6% withdrawal rate is safe for an 80-year-old, and an 8% withdrawal rate is safe for a 90-year-old. So I think the most important takeaway here is to really pay attention to your rate of withdrawals, especially in your early years, because the longevity is a risk in retirement and the other things like long-term care. So in any given years, when you have unexpected events, that rate of withdrawal isn't going to stay at a steady 4 or 5, 6 or 8%. It's going to vary. So we want to have a plan for that. Okay. So sorry. All right. So choices in managing distributions, which accounts to distribute from first? When you go from that accumulation to distribution phase, we really want to focus on having a tailored cash flow withdrawal strategy for you. And so, there are questions like, where do you take it first from? Do you take it from non-qualified, traditional IRAs, 401ks, Roth? There's also required minimum distributions to consider. For most folks, if you were born 1960 or later, your requirement minimum distribution starts at age 75. Your pre-tax dollars, they have been growing, and the IRS is going to force you depending on when you were born, to start taking distributions from your pre-tax accounts. So that is something to consider. And the tax consequences of when those are going to start. And if you withdraw less than the required minimum distribution, you could face a substantial tax penalty. So plan ahead by spending more or converting to Roth IRA. If you have mostly pre-tax dollars and you're going to have a good amount of income sources such as pensions, Social Security, and that is estimated to cover most of your expenses, then your required minimum distributions, you might be forced to take more income than you need, which is going to equate to paying more taxes than you need to. So, so that is where a Roth conversion can come into play. And after you're 70 and a half, you also have the availability to do what's called qualified charitable distributions. This is an above the line deduction where you can, and it has to come from an IRA, but you can satisfy your required minimum distributions and send part of it or all of it to a 501c, a qualified charity. Okay, so choices with tax planning. This is also very important, especially when you have different types of income that can come into play. So there are some considerations for minimizing tax liability. Hold assets generating interest income in qualified accounts. Hold assets generating dividends or capital gains in non-qualified accounts. Use distributions from different accounts types and different assets. Withdraw qualified assets before required to reduce future tax bills, especially with large IRAs. Focus on maximizing lifetime after-tax income instead of minimizing current tax bill. So this is some examples of the tax implications of the different income sources. So Social Security, typically 85% is taxed at ordinary income. Pensions and annuity income is taxed at ordinary income. Interest income taxed as ordinary income. Distributions from IRAs and 401k distributions, ordinary. Dividend income, it can be taxed as ordinary income or capital gain, depending on the underlying security. Long-term capital gains, taxed as capital gain. Roth IRA is not subject to taxation. Liquidation of investment principal is not subject to taxation. Okay. And step 4, which is the final process of the financial planning process, review and monitor your progress. So as we review, you will be ahead of your plan or behind plan. We will determine why and make needed adjustments. So assets, are your assets higher or lower than projected? Income, was your income estimate correct? Did you receive unexpected cash inflows? Spending, was your spending as you anticipated? Portfolio, was your portfolio return higher or lower than estimated? Does your portfolio need rebalancing? Withdrawal rate, is your actual withdrawal rate sustainable? Does it coincide with an expected level of success that you are comfortable with? Inflation, do you need a spending increase for inflation? Retirement goals and expectations, have your retirement goals and expectations change? And furthermore, make adjustments as you need to help you stay on track. Spending strategies track the success of your portfolio. Are you ahead or behind? Did you spend too little, too much? Did the markets do better or worse than expected? Withdrawal strategies. Are you still comfortable with the current strategy? Investment strategies. Has your comfort level or goals changed that you need to reevaluate your investments? Rebalance accounts based on market performance, risk, and income needs. So emotions can destroy your plan. I think there is a huge correlation between finance and emotional health. I recently did a podcast with James on finance and mental health. So there are some cycles of market emotions. There's going to be some examples, from optimism, excitement, thrill, euphoria, anxiety, denial, fear, desperation, panic, calculation, dependency, depression, hope, relief, and optimism. So that is kind of like a cycle of market emotions. And so there's always a reason to sell. And I think the key takeaway here is to be careful of market timing. It is important to stay invested. Since you can see here, there has been a number of different market events, and every single one of these caused fear. The unknown is what causes volatility in the market. And if you were to act emotionally and get out of the market when the markets are experiencing a downturn, and let's say go into cash, and you want to get back in when the markets recover, by the time you get back into the market, most likely you will have missed the high point. So staying invested, studies have shown that dollar cost averaging produces much better results than market timing. So speaking with your finance professional to have a plan to have a strategy with the what ifs. There are different cash flow strategies where we can deploy one of those three strategies that I explained earlier, from income only to a systematic withdrawal to bucket approach. And depending on where we are in the market, or your appetite for risk and your expenses, if those change, having a plan and devising a strategy and maybe shifting between one of those three could make sense for you. Okay. How will a recession affect my emotions? So this is a really good visual of how growth and volatility can impact your emotions. So if you have a 60-40 investment, meaning that you are invested 60% in stocks and 40% in bonds, you can see here there are a lot of different emotions that can come with the good and the bad times. Greed and fear can lead to buying high or selling low. It is important to have a process designed to prevent you from making the wrong decisions based on emotions. So build a portfolio that seeks to protect on the downside, protect your essential expenses with a solid foundation, employ strategies for volatile markets, withdrawal strategies, spending and harvesting strategies. Pre-plan for what you will do when you are ahead of or behind plan. So bottom line, have a plan. So are you ready to retire? Envision what you want your retirement to look like, what's important to you, understand the risk, longevity, inflation, market performance, healthcare costs. Create a plan to address those risks. Prioritize your life goals, set realistic expectations. What will your investment strategy be? What will your withdrawal strategy be? Review and monitor progress. Don't let emotions derail your plan. Okay, so that was the presentation, and I have the chat box open, and I welcome any questions that anyone may have. We have advisors here. If you are a client, I welcome you to reach out to your advisor for additional questions or myself. Again, we have a number of amazing resources available on bogartwealth.com. We have webinars, we have podcasts, and I know this was a lot that I covered today. But I think the biggest takeaway here is to have a plan, because you want to have a plan for the things that you can't control. There are certain things that that you can control, but others that you can't. And having that tailored plan that's specific to your goals that's really what's critical. So it's never too early to get started. And we here at Bogart Wealth, we are very knowledgeable with different plan rules, all different resources that we have available to you with Social Security, Medicare, and how to incorporate all those different income sources and bring them all together that makes sense for you. So I thank you so much for joining the webinar today. I am going to just wait one more minute to see if I see any questions coming in. I do not at this point, but thank you so much for joining today, and hope to see you during our next webinar. Thank you and have a great day.